Welcome to week 21 of the GoldMining Swissie USDCHF Recovery Series. Today, we're looking at the ongoing reality of an automated trading system. Specifically, we're tracking a grid and martingale strategy. If you're familiar with the space, you know that essentially means it averages down on losing trades, banking on a swift market reversal. Now, our approach here is calm and completely grounded in reality. There's zero hype in this explainer. We're just looking at the unvarnished mechanics of algorithmic recovery on a live cent account. This journal is all about documenting that daily, mathematical grind of survival in the currency markets.
You know, in the world of automated trading, it is incredibly easy to just get completely lost in the day-to-day noise. But for this update, we're exploring the quiet, mechanical nature of a small weekly win, and we're setting that against the backdrop of a massive macro reality. We really want to dissect how the system is behaving right now, deep in the trenches of the USDCHF market, as it attempts to dig its way out of a pretty significant historical hole. It's an incredibly delicate balancing act, trying to capture those small, incremental profits while completely avoiding catastrophic ruin. So let's start with the immediate good news for the week, keeping things completely transparent. The account actually secured a modest but absolutely positive 4.46% gain for week 21. It's a solid, functional step forward. And what this does is validate that, given the current market conditions, the underlying logic of the expert advisor is operating exactly as it was intended to. It's capturing small retracements without exposing the overall account to unnecessary or immediate risk. For a system that's literally designed to survive deep drawdowns, these small, consistent steps forward are the lifeblood of its recovery. Every single percentage point earned is just one step further away from the brink. When we look at the raw data pulled straight from the MetaTrader 5 terminal, that 4.46% growth translates to exactly 77.12 cents in gross profit. But, you know, the true victory here, especially during a recovery phase, is actually the drawdown metric. It was just 0.44% for the week. The EA maintained a really healthy 59.82% trading activity rate. That means it was highly engaged in the market, but fiercely defensive of its capital. When you're operating from a deficit, capital preservation is just as absolutely crucial as capital generation. So keeping that weekly drawdown under 0.5%, that is a real testament to the system's current defensive posture. Let's zoom into the specific trade mechanics to see this strategy at work. Notice the scaling logic in the buy positions. An initial 0.04 lot position is followed by a doubled 0.08 lot position. This is that Martingale system in action, layering into a downward movement, waiting patiently for the mean reversion, and then closing the entire sequence in profit. It successfully captured the necessary recovery movement while completely neutralizing the downside. It is, by definition, a mechanical, emotionless execution. The system didn't panic when the price dropped, it just calmly executed its mathematical programming, waited for the bounce, and secured those 77 cents. But the crucial point here is understanding exactly why the market provided these specific conditions. This week's USD-CHF price action certainly didn't happen in a vacuum. The volatility was primarily driven by shifting expectations surrounding the Federal Reserve. We saw U.S. inflation sentiment oscillating, and that directly impacted Treasury yield movements. And, as always, whenever there is global macroeconomic uncertainty, we inevitably see safe haven flows moving into the Swiss franc. It's a currency historically backed by massive gold reserves and a long-standing reputation for political neutrality. So the EA essentially fed off this highly specific tug-of-war between the dollar and the Swissie. However, we need to pivot sharply to the macro reality here. Despite a flawless operational week and that 4.46% gain, the total lifetime growth of this account still sits at a negative 24.45%. And that is the stark truth of the GoldMining Swissie Journal. A good week is really just a drop in the bucket when you are operating from a deep deficit. We want to completely strip away any illusions of easy money here. A single successful week simply does not erase a devastating historical quarter. The lifetime trajectory tells a pretty sobering story. After an initial climb back in late 2025, a massive historical equity drop occurred. The equity line plunged violently, dragging the account balance right down with it. We are prioritizing radical transparency with this explainer. The climb back to the high watermark is going to be incredibly slow. As the recent flatline progression clearly shows, this is a daily, grueling grind. The system is no longer compounding rapid gains. Instead, it is meticulously chipping away at a mountain of past losses. To put a specific number on that pain, the maximum historical drawdown peaked at a severe 65.44%. Over half the account's equity was exposed and underwater at its absolute worst point. Just imagine watching more than half of your capital vanish, knowing that a few more adverse pips could literally wipe out everything. Factually presenting this extreme stress is vital for us. It shows exactly what the expert advisor has managed to survive, but it also serves as a permanent scar on the account's history. It is a constant reminder of the inherent systemic dangers that are always lurking right behind the code.
The lifetime stats really reveal the true uphill battle we're looking at. With a current balance of 1806 cents and equity trailing slightly at 1778 cents, the profit factor sits at 0.97. Simply put, the profit factor measures gross profit against gross loss. So for every dollar lost historically, the system is only making 97 cents back overall. The recovery factor, which is a measure of risk compared to reward, is deeply negative at minus 0.19. That shows just how much risk the system took on just to get to its current battered state. And yet, with a lifetime activity rate of 91.9%, the account is very much alive and grinding, even against these incredibly steep mathematical odds. It is fighting for every single cent. Which brings us to a very sober reality check. Recovery is never guaranteed. We have to be completely honest about the systemic dangers of grid and martingale strategies. While they can absolutely produce weeks of consistent low-stress wins like we just saw, their long-term survival after deep drawdowns is mathematically fragile. If the market trends aggressively in one direction without bouncing back, the risk of a cascading margin call where the account literally runs out of funds and collapses to zero, well, that risk is always present. We are surviving, but make no mistake, we are walking a tightrope without a safety net.
So week 21 was a small, successful step. It provided evidence that the system is functioning and gradually rebuilding toward our long-term 10,000-cent goal. But remember, it's just one chapter in a much larger story, a story defined by real accounts, real risk, and real progression. I'd like to invite you to subscribe and follow the ongoing GoldMining Swissie recovery journey. Yes, the system survived today, navigating the turbulent waters of the currency market with mechanical precision. But in a market that can turn in an absolute instant, will the math hold out tomorrow? We'll be back next week to find out.